Well, good evening, everyone. Thank you for dialing in today, and thank you for taking the time out of your busy days in order to listen to us. By way of an introduction, my name is Ernest. I am one of the investment advisors here at Standard Chartered, and I'm your host for this evening's event. And so it really has been a roller coaster ride for investors over these last few days. Ever since President Trump put his tariff announcements in, it has been a wild ride in markets. And so plenty of questions arise. How do we position our portfolios amidst all of these chaos, confusion, and uncertainty overall? And to help us do this, we have invited Chi Siu, who is one of our portfolio strategists at SCB. He is part of the asset allocation team. He identifies investment opportunities and thematic ideas across asset classes, and is also part of our bank's global investment committee. Prior to joining this, he was also part of the World Gold Council, where he advised governments on gold reserve management and enhancing the gold market. So he's really got all of the expertise and knowledge to be able to help you in these challenging times, and we're very, very grateful to have him here today. So we'll begin this session by interviewing Chi Siu, taking a kind of more theoretical approach. And later on, I'll follow up from everything that he said with more practical advice on how to implement everything that we've discussed. So please ask questions in the Zoom chat. In the meanwhile, there is a Q&A box that you can look at, and we'll take them as we go along. So cutting to the chase, Chi Siu, what are we expecting this year out of the global economy?
Good evening, everyone, and thank you, Ernest, for having me here today. So there are three things that we currently expect to play out for the remainder of the year. First, we think that US will eventually strike trade deals with its trading partners and that tariffs will eventually be watered down by the end of the year. Second, we still expect the US to achieve a soft landing. So soft landing means that growth in the US will slow, likely well below 2%, but not yet to the point that there is a recession. Third, while we do think that there are upside risks to inflation, any spike in inflation will likely be transitory. So in summary, low tariffs by the end of the year, slower US growth, but no recession, and upside risks to inflation that would likely be transitory.
So that's kind of a segue into another question. And I'm sure, with all of this tariff uncertainty, why is the team putting a 20% probability on a recession? And why isn't it higher, like maybe some other banks on the street might have?
I mean, you're right. I think a 20% recession probability does sound a bit optimistic. But to be honest, we're not too far off from the consensus right now. Consensus is around 30%. And it's true that the impact to US growth from tariffs, at least in the current form, will be substantial. There are many estimates out there, but I think the consensus is warming towards a sub 1% growth in the US for the year. Now, this is definitely not ideal, but it's also not the end of the world yet. If you take a collective sweep of all the US data, the US economy is actually still looking quite resilient. The labor market is still healthy. Leading indicators are still improving. And we also think that Trump is just front-loading all the bad stuff, like Dodge cuts, immigration cuts, tariffs, and backloading or pushing back his more pro-growth agenda, like deregulations and tax cuts, so that by the time the 2026 midterm elections come, that's all that people can think about. So yes, even though tariffs are negative for the US economy, we do think that the good stuff will start coming in the later part of the year. And for these reasons, we continue to see the US as being able to achieve a soft landing for this year. For inflation, as I mentioned earlier, we do think it is quite hard to imagine that a spike in inflation can be avoided. Even if exporters reduce their prices and US retailers absorb some of the tariffs, a certain portion will still be passed on to consumers. And if the increase in average tariff rate is around 15%, the worst case scenario is that you could see more than a percentage point jump in inflation. This would mean headline CPI jumping to around 3.5, 3.6%. But just to be clear, this estimation is the extreme scenario that assumes consumers will bear the entirety of the tariffs. In reality, the exporters, retailers, even currency appreciation will have to offset a portion of the tariffs. And it's also very likely that tariffs will be watered down over the coming months. But nonetheless, inflation is something that we are watching very closely.
So it sounds like a range of scenarios could be developed, but maybe the worst can be avoided. And so I want let's elaborate on that, right? So what do we kind of expect in each of these scenarios if they play out, the soft landing, this no landing, this hard landing? So what does this mean for people who are invested overall?
So we have three broad scenarios that you can consider to help you craft your own investment decisions. First, as I mentioned earlier, our base case is that Trump bows to pressure and seals deals with trading partners, and we're already seeing possibilities of these. So far, besides China, there do not appear to be any appetite from other countries to retaliate. Europe has already paused their own tariffs. Japan, South Korea, ASEAN, all very eager to negotiate. And most other countries like Australia and Singapore are all choosing not to retaliate. So it's very likely that we hear some trade deals announced over the coming months. And in our base case scenario, the S&P could end the year around 6,200, which is roughly a 15% upside from current prices. The more bearish scenario is that the US falls into a mild recession, either because the trade talks fail or because the uncertainty lasts for so long that the loss in confidence in businesses or consumers starts to impact the hard data. And in this scenario, the Fed will likely be stuck in between a rock and a hard place because inflation may spike while growth is contracting. In this scenario, we do see the S&P 500 dropping to around 5,000, which is around an 8% downside from current prices. On the other hand, the upside scenario is that trade deals are done. China and Europe, they stimulate their economies, and the US shifts to more domestic issues like tax cuts, deregulations. And in this case, we do see quite a substantial gain of 20% in the S&P 500. So the risk reward actually looks quite attractive. In the bear case, you have 8% downside, and in the bull case, it's a 20% gain. And historically, if you look back at data dating back to the 1970s, the statistics actually fits quite well with our view because every time the S&P 500 falls by 10% from its peak, there is roughly a 60% chance that it still produces gains by the end of the year, provided there is no recession. If there is a recession, this probability drops to slightly below 50%. But if you look at the returns, after a 10% drawdown between a mild recession and a no recession scenario, it's between the range of a loss of 5% and a gain of 12%. So statistically, the risk reward for the S&P 500 actually looks quite attractive, even when we do not consider these three scenarios.
Right. And so that makes sense, right? Generally we would say to add on lows at this point in time. And so there are probably clients who might be thinking of buying the dip, taking advantage of this pullback to kind of add on towards positions kind of in the medium to long term. And so what would you say to these clients in terms of looking for opportunities within equities, particularly region? Are we just only looking at the US or are we looking elsewhere?
Well, we continue to like European equities. I mean, the announcements of US tariffs has spared no equity markets, and this certainly includes Europe. But there are a few things to highlight. The longer this sell America narrative remains in place, the more European equities will actually benefit from this investor rotation. And we're already seeing this play out in terms of returns, right? If you look at the performance between major equity markets since Liberation Day, the MSCI Europe ex-UK index has actually done the best. It has beaten both Japan and UK stocks, and in our portfolio, it's actually the best performing risk asset since 2nd April, behind only EM local currency bonds, which has actually benefited from the weaker US dollar. And this investor rotation is also playing out in currencies. So Swiss franc, the yen, they are the more talked about safe havens during this period. But what has been less talked about is how well the euro dollar has been doing. In fact, it's just a little bit behind the yen in terms of returns since Liberation Day. But beyond tariffs, a big part of why we are optimistic in Europe is due to fundamentals. Economic conditions, earning estimates, they have both been improving, and Germany easing their debt limits is also a game changer for us. And there are estimates out there that their new spending program will actually boost growth by 2% annually for more than a decade. Valuation-wise, slightly more expensive now relative to history, but still cheaper than peers.
So plenty of opportunities beyond the headlines, and particularly in Europe, as that is at this time in time. So we would just like to remind everyone that you can post any and all questions in the Q&A chat, and we are happy to address them as we go along. So please do so. So actually, one of the questions that was posted is actually one that we will address on the very next slide, which is, are there any particular sectors that we should look at that will maybe help to avoid some of the tariff turmoil?
We do think there are some interesting opportunities out there, which are both defensive in nature, but also with upside potential in the event that risk sentiment starts to improve again. And US communication services is one of them. If you look at the return since 2nd April, which was the Liberation Day, US communication services is actually one of the better performing US sectors, behind probably only utilities and consumer staples, which are more defensive in nature. And if you look at the largest companies in these sectors, you have Meta, you have Alphabet, Netflix. These companies, of course, they are not immune to any secondary effects of tariff-led weakening in growth. But in terms of direct tariff risk, they are much less vulnerable because the focus of Trump's tariffs have been on goods, not services, and the products of these companies are mostly services. So unless Europe decides to implement tariffs on services in retaliation, which we think is quite unlikely, these companies' exposure to China is already quite limited because, as you may be aware, Google, YouTube, Facebook, they've all been banned in China for quite some time now. Second is US tech software, and depending on which index you look at, Microsoft is actually by far the largest holding in the US tech software space. And Microsoft has actually been the most resilient of the Magnificent Seven stocks since Liberation Day. In fact, before yesterday's sell-off, Microsoft was actually up slightly since 2nd April. And Microsoft, along with most of the other companies in this sector, they already have limited exposure to China. And as software services companies, they're also less exposed to tariffs. So we do find these two US sectors interesting. They are less exposed to tariffs, but at the same time, they are also growth sectors, which means they also stand to benefit should sentiment improve. Outside the US, we like European banks, we like European industrials. European banks have more domestic exposure, so less exposed to tariffs, while industrials also stand to benefit from Germany's fiscal push. We also continue to like China non-financial high dividend state-owned enterprises, SOEs. This trade has actually done really well for us the last few months, and we continue to expect it to do well, mainly because it's very stable and it's very nice to be able to clip coupons from these high dividend stocks, especially during this period of volatility.
So actually, beyond the surface, again, a lot of interesting opportunities and maybe areas that people don't necessarily expect, like European banks, for example. And so I think following on from that, let's talk a little bit about another set of clients, right? Because there are a whole other set of clients that are also very concerned about uncertainty, and they will prefer a higher level of portfolio safety at this point in time, especially if their existing portfolio is already quite pro-risk. And so for those people looking to still remain invested or invest more capital, but are looking for a higher degree of safety amidst this uncertainty, what kind of assets should we be looking at in the portfolio?
So the traditional US safe havens like long duration treasuries and the US dollar, they have not been working as expected because there are concerns about stagflation or China selling treasuries in retaliation to tariffs. So instead of these traditional safe havens, there are a couple of other assets that you can look at to hedge your portfolio. First, gold, of course, very important. The 90-day pause in tariffs has relieved some concerns about tariffs, but it has also extended uncertainty for a longer period of time. And as long as there is still uncertainty in the market, gold will continue to benefit. Safe haven currencies like the yen, Swiss franc, they have both been doing very well. In fact, the Swiss franc has been by far the best performing asset, I think, overall since April 2nd. But between the yen and the Swiss franc, we do need to highlight that we have a preference for the yen because we think that further gains in the Swiss franc may be limited due to the risk of intervention by the Swiss National Bank. Switzerland, they already have one of the lowest inflation in the developed world, and a strong currency will only make imports cheaper, and this will bring more downside risk to inflation. And the Swiss National Bank, they do have a historical tendency to intervene in the FX market. So although the Swiss franc has done well, it's actually much riskier than the yen, where we do expect the BOJ to continue tightening monetary policies. I think lastly, you can look at defensive equity sectors. Interesting enough, Indian consumer staples, for example, has actually been one of the best performing equity sectors since April 2nd. India tariffs are less severe than expected. The RBI has already eased monetary policies, and the rupee has actually been quite stable versus the US dollar.
So short duration treasuries, the Japanese yen, certain Indian equities, all possible hedges to your overall portfolio. And so I kind of want to take another question from the audience while we are discussing sector and regional allocation. And Chisio, I want to hear your thoughts on Southeast Asia, because I think Southeast Asia has seen quite a fair bit of volatility since Liberation Day as well. Indonesia has come under pressure, Malaysia has come under pressure. And so could we get your view on how the team sees Southeast Asian equities at this time?
So in terms of tariff impact, I would say I'll categorize the countries into three different camps in terms of ease of securing trade deals. I think in the first camp, I think Japan, India, Korea, and Indonesia, they are the low-hanging fruits, and I think they are very likely to eventually secure a deal. Thailand, Malaysia, and along with Taiwan and Europe, they are in a more difficult position because their trade surpluses with the US are larger, and in the case of Europe, there's also a lot of bureaucracy and diverging interests. And the most difficult group would be China and Vietnam for obvious reasons. So I would say, even though ASEAN is presenting a united front in talking with the US, I think there will be diverging difficulties in terms of securing a trade deal. I think Indonesia stands to secure a deal a bit faster than the rest, but fundamentally speaking, I think Indonesia is going through some issues on their own. So even with this tariff headwind removed, probably not a good time to start buying the dip in Indonesian equities.
So dispersion even within Southeast Asia as well, and we can't necessarily treat all markets the same. And so that's great. And I want to now talk about something a bit broader. And so I think over here, we've been encouraging people to build diversified foundation models, foundation portfolios. And one of the best ways to do so is, of course, through the Signature CIO funds, which is managed by in conjunction with the team in Singapore. And so could you help talk about the overall performance of these strategies and how they have held up against the volatility we faced?
So it has definitely been a turbulent few weeks, but I would say our CIO funds have weathered the storm relatively well. And in times like these, you can see the merits of having a diversified portfolio, because even in the midst of a peak to trough drop of 20% in the S&P 500 and losses in both US Treasuries and US dollar, the damage to our portfolios have been relatively minor. But nonetheless, the performance of some of our strategies has been softer than our longer term track record. It has been a very complex investment environment, and some of our calls, which are designed to add value over time, haven't played out as expected. For example, our position in EM high yield bonds, which is an important source of yield in our income portfolio, and our larger than benchmark position in EM hard currency bonds, for example, they have both actually hurt us quite a bit during this period. But the good news is, I think our portfolios have managed to bounce back quite a bit. Our income strategy is now down 0.8% for the year. It's not great, of course, but compared to just 1 week ago, it was down around 4%. Our balanced portfolio has also performed roughly in line with the global 60-40 equity bonds portfolio. And some of our calls have actually worked out really well. Gold, for example, is up almost 25% this year, and we have been overweight on gold for several quarters now. And I think in addition, we also upgraded our EM local currency bonds position. It was quite a timely upgrade because it has also done very well in this period of US dollar weakness. But we're not taking anything for granted. we are still prepared for more volatility ahead, and we are staying nimble with our allocations so that we can quickly adapt to any changes in the US policy or the markets. And in the meantime, we're also using this period to reassess our exposures. Valuations look a lot more reasonable in some assets, and we're also freeing up cash in the portfolio to capitalize on these opportunities so as to, set the stage for stronger returns down the road.
And so can you kind of walk us through, again, in a little bit more detail, some of those positioning changes that you've implemented over the last month or so?
So we have certainly been very busy behind the scenes. Trump is known to issue very big threats that ultimately amounted to nothing, but we didn't take his threats lightly. We have actually been taking quite a bit of precaution heading into 2nd April. In our risk-based portfolio, we've been cutting back on our exposure to US equities even before 2nd April, because we felt that the risk-reward was getting increasingly unattractive, even though the fundamentals were still resilient. In contrast, we have been adding to our European equity exposure. Europe is historically the primary beneficiary of any investor rotation of the US. So heading into Liberation Day, we wanted to hedge these tariff risks. And on top of that, as I mentioned earlier, fundamentals in Europe have been improving. But overall, between the equity regions, we are now neutral across the board, because we do think that diversification is now very important. And until we have more clarity concerning US policy, we do think that a neutral stance makes sense for now. In bonds, we cut our exposure to DM high yield. But in hindsight, I think we could have gone a bit further in reducing this position. But we chose to take a bit more risk in bonds mainly because we have really neutralized our exposure in equity regions. We have also reduced our allocation to DM government bonds because we have been unsure about the Treasury's role as a portfolio diversifier. The correlation to equities has been quite unstable, and so we actually prefer to hedge our portfolio with gold instead, which we have added significantly over recent months. In terms of our income portfolio, we have also taken steps to increase the overall defensiveness of the portfolio, but at the same time also making sure to not jeopardize portfolio yield. We added to US agency mortgage-backed bonds because this asset class has comparable credit quality as US Treasuries, but also offers higher yield. So adding to MBS actually increases the portfolio defensiveness, but without impacting the portfolio yield. We have trimmed our DM high yield position and added to DM government bonds since 11 April. And this has turned out to be quite timely because that proved to be the peak in US 10-year yields, and it has since fallen by around 20 basis points. We added to EM local currency bonds. As I mentioned, this has worked out quite well for us due to the weaker dollar. And I think what didn't really work for us was our preference for global equities over high dividend equities. This has hurt us, and we have also reversed our preference. Dividend stocks usually are more defensive in nature and they tend to be less volatile because a larger part of their returns come from dividends. And during this period of uncertainty, we do prefer to clip the coupons instead. I think last but not least, we also opened a new position in US inflation protected treasuries. And this is just to hedge against the risk of a resurgence in inflation.
Yeah. Thank you, GCU. Very insightful. So the team was already cutting risk before Liberation Day, and even now are taking steps to proactively manage risk even through all of this uncertainty. And I just have one more question on you before we move quickly to the next section. As far as the team sees US tech specifically in semiconductors as well as software together, in the short term, looking in the next 3 months, can we get a sense of how that's likely to perform? And also more broadly, when we look at US equities, S&P 500 as well as the NASDAQ, does the team think that we've seen the bottom yet? Or do you think that there's more downside to come?
Well, in terms of semiconductors, I think we have been somewhat bearish on NVIDIA for some time now. I think a lot of these very large orders from Tesla, from Facebook that really boosted NVIDIA's stock, I think last year, we do see them as a one-time thing, and we do not expect them to be repeated. And the semiconductor sector is very sensitive to economic cycles. And if these tariffs do lead to a slower growth, not just in the US and the rest of the world, we do think that the semiconductor sector will actually start to suffer. In terms of where we see the bottom is, in terms of US equities, to be honest, I think it's really hard to tell where the bottom is. We do have a neutral view across equity regions. So this means that if you are already overweight US equities and maybe you can take the opportunity to sell on strength to bring your US equity position back to neutral. If you're underweight US equities really and you are a long-term investor, then you can take any weakness to slowly add to your position to average in to bring it back up to neutral.
Okay, thank you very much. Insightful on that. Well, we don't have all the answers, but I would just like to quickly summarize everything that we've discussed over the last 20 minutes. The team's base case is that there will be no recession this year. There will be a soft landing, and maybe the impact of tariffs will not be as severe as anticipated. There are still opportunities in the market, especially right now. European equities look particularly attractive. Portfolio hedges like short-term treasuries, and more likely gold might help you overall in adding defensiveness. And finally, and more broadly, the signature CIO funds and the strength of a diversified approach has really proven itself this year, being down 1 to 3% in a time in which the markets have pulled back quite considerably. So thank you very much, Chi Siu. And now he has offered quite a theoretical view on things, and I want to talk a little bit more about practical advice for investors, both from a kind of investor psychology perspective, as well as specific product implementation over a mid to long-term period. So let's begin by talking about what the past and the future, because this is not the first time that we have seen a crisis in markets, and this will not be the last time either. But history can give us a kind of good guide to what to expect in the following 12 months. And notably, in steep losses in the S&P 500 over time have actually led to steep gains in the following year. And this is through different market scenarios. And so we have a few different scenarios here, like, for example, the 1980 recession, like Black Monday, the worst day in the history of the S&P 500, the 1990s recession, the dot-com bubble. And so all of these were serious events that saw the S&P 500 come down more than 15%. And that's where we are now. And yet, after that, they were followed by strong double-digit gains in the following year. And so, yes, good markets do not last forever. And that's something to always remind ourselves of in good times. But certainly bad markets don't last forever either. And in general, they last less long than people think. And the recovery is faster than people think. So that's the first bit. Losses are followed by gains. Good markets don't last forever, but bad markets don't last forever either. And they recover faster than you think. And I will also stress that we have seen this kind of volatility before, even in strong years. And so from the top to the bottom in the S&P 500 this year, the drawdown was around 20%. But we've actually seen that before, and we've actually seen that 3 times in the last 6 years, going back to 2018. And so if you had told anyone at the beginning of 2018 that the S&P 500 would see 3 separate minus 20% drawdowns, I mean, most people would say, yeah, let's not bother with it. Let's just hold on to cash and sit tight. And yet, if you had bought the S&P 500 at 2018, weathered through the storm, through the up and down, you would have doubled your money from there. So volatility is normal. This kind of drawdown, we've seen that before, even in recent times. But we are confident that long-term returns are there for people who are willing to hold through market cycles. And in a sense, the volatility that we face is the price that we pay for the strength of returns, particularly in equities. So again, this is not new. This time isn't different. We have seen this kind of crisis before, and markets have seen their way through. Finally, I do want to talk about timing versus time in the market. And so I think there is the perception that a lot of people have, which is, don't catch a falling knife, wait for things to settle down before kind of going back into the market. And timing isn't as important as people think it is. And so we have a chart here showing the worst investor in the world, someone with truly terrible timing who only invests before market drawdowns, of 20% or more. And you can see, even in this kind of environment where you only invest 100,000 before big market drops, for an investor who is holding through the entire market cycle without selling, their annualized returns, even after this recent pullback, turned out to be about 6%. And so, yes, the most important things out there, asset allocation, making sure you are sufficiently diversified and remaining in the market, allowing the market to recover, letting compounding work for you. In this case, you can get timing completely wrong and still find yourself with good returns in the long term. This kind of is a nice segue into practical implementation. And now we're going to talk a little bit about specific ideas that you can implement. So do bear in mind, these are specific product ideas and are an advertisement. Please speak to your relationship managers before pursuing any products, and just make sure your risk preferences are in line. So we mentioned the signature CIO funds earlier, and we talked about the importance of building a strong foundation in times past. There is no better time to build a foundation. The best time is now. And we think the signature CIO funds do a very good job at that. And so why do they deserve to be the foundation of your portfolio? They're all in one. So they're extremely diversified across the board, across asset classes, within asset classes, across sectors. It's really a whole diversified portfolio in a single fund. And we've seen that that is really good at handling volatility. Second, you have the benefit of the fund select team, the chief investment office team, the discretionary portfolio managed team, who all have expertise like Jisoo in looking and analyzing the market and helping us to understand everything around this. And finally, you can look at the last bit, which is about rebalancing. And that's probably one of the best things about this strategy, is that it's flexible and able to adapt and move when the situation demands it. And so the CIO team, as Jisoo was saying, is keeping a close eye on markets and able to move when the situation demands it. This basically takes time back for you and ultimately results in hopefully better performance in the long run. So the signature CIO funds, a great way to build a strong foundation. And if you don't already have one, that's something that's really good to add. But for investors who already do have a strong foundation and are looking at adding opportunistic ideas on top, now we'd like to talk about some ideas that you can look at that fit the current market and are also good opportunities. So we will begin by talking about Signature Select US Allocation, which is our newest fund, which we have just onboarded here. This is a diversified US-only multi-asset strategy run by T. Rowe Price, one of the largest fund managers in the United States. And so this is really meant for people who are looking for capital gains in the long term, but who don't necessarily want to take on the volatility of the S&P 500. So over time, the strategy has shown that it can deliver near equity-like returns with much lower volatility than the overall index. And so that is an attractive proposition overall, and something that we are offering to our clients for the first time, because the strategy has been closed to outside investments since 2014 and is now only open. To give you an idea, here is some performance data of the underlying strategy. And you can see ever since inception, it's almost matched the S&P 500, which is equities only, on a diversified multi-asset portfolio. And that is extremely impressive. It's done so on significantly lower volatility. As we can see, the standard deviation and max drawdowns are lower than the S&P 500. And that's resulted in portfolios that make investors sleep better at night, but with performance with equity-like returns. So if you've already got a strong foundation portfolio, this is one of the options that you can add on top. Again, US equity-like returns without the risk of US equities. So there are other options as well. We will look at two of them in particular. And the first, many of you are looking at options for portfolio safety, and bonds are one of the options that we can look at as well. Yields, particularly on the long end, particularly when we look at 10-year, have come up significantly from the lows. And this presents a good opportunity for investors to buy in at lower prices than we would have had otherwise. They're a great, reliable income option, a good diversifier from equities, and right now, more attractive than they were even a couple of weeks ago. So On our shelf, we have over 300 bonds in a variety of different currencies, ranging from US dollars to pounds to Australian dollars to ringgit, in a variety of different types, government bonds, state bonds, corporate bonds. And honestly, with yields this high, they're a great opportunity to lock in the yields and have a higher degree of safety for people who are looking to have a safe income option at this time. So again, plenty of retail bonds, a good opportunity for portfolio safety. And finally, kind of another option for income is a fixed coupon note. And a fixed coupon note is a way for clients to get equity-like returns without necessarily bearing the full downside risk of equity. So these are short-term structured products, more tactical in nature, benefit from high volatility, and right now pricing is a lot better, parameters are better, and enable clients to really get some equity returns, some exposure to that without necessarily fully participating in the complete downside. So this is kind of a bit more of a balanced option. Please speak with your relationship managers if you would like to talk specifically about structured products in and amidst market volatility. We are conscious of the fact that we are overrunning, so we'll take one or two more questions before we have to close this off today. So if we're looking at the questions, there's one question that I think we will answer live, and Chisu is already typing an answer to the other one. We want to know the overall view on the USD versus the ringgit. And Chisu, if you could shed some color on this, where does the team see the dollar heading within, well, the question says the next 6 months, but let's say the next 6 months to 1 year. So where do we see the dollar going?
So as long as this US only slowdown narrative remains, the US dollar will typically struggle. So there is this concept called the US dollar smug. Essentially, what the concept is trying to say is that when the US is in a slowdown, while the rest of the world is doing better, usually US assets will underperform the rest of the world. And that's what we have actually been seeing. US treasuries typically not as effective during a US only slowdown. US dollar is weaker because unlike in a global recession where capital from across the world flow into the US for stability, in a US only slowdown, capital actually leaves the US in search for better opportunities elsewhere. So as long as this sell American narrative remains, which we believe will still be for quite some time until suddenly a trade deal is announced. We do think that there'll be more downside in the USD. But on the flip side, it seems like technically the dollar index hasn't been able to sustainably break below 99, which would suggest that for now the long-term range still remains intact. But we do think that the bias is still to the downside for the US dollar.
Bias to the downside for the dollar. So thank you very much, and thank you for helping to answer all of those other questions that we have faced as well. Again, conscious that we have overrun, so I want to ask you one final question, Chisu. If there is one message that you can leave for our clients today, based on everything that we've said so far, what would it be and why?
I think things will get better. I think there's a tendency for things to look very gloom and dark, when we're in the thick of it, when we're in the eye of the storm. I think during COVID, they were saying that it would take 4 or 5 years for the vaccine to be developed. There could be tens of millions of people dying. But in the end, innovation and humanity sort of strive, right? And we created a vaccine in a year. So I think, there's a tendency to be overly pessimistic in the eye of the storm, but you just have to remind yourself that even this will pass one day.
Yeah, thank you very much. And if there is one thing I would like to say to all of our clients, it is that good times don't last forever, but bad times don't last forever either. And yes, this period of volatility has not been easy, but as history has shown us, the markets have overcome worse crises before. And for investors that are willing to put capital to work at this time, they may find themselves better off than they think. So thank you very much for dialing in today. Thank you, Chi-Siu, for joining us and addressing our clients. If you have any further questions about the market, or if you would like to discuss your portfolio further, please reach out to your respective relationship managers to set up your portfolio conversations there. With that in mind, thank you all very much for your time and have a great evening. We'll end the webinar.